Hello, everyone. Good morning, good afternoon, or good evening, wherever you are in the world. Thank you very much for joining us for what I think is going to shape up to be an excellent hour, talking about a topic that is definitely dear to my heart, and I know is dear to the heart of the three folks that are with me today. Kicking and screaming, changing the insurance industry. It's a topic that we all love to talk about at the bar, at least pre-pandemic. I'm sure we're all going to be doing the same as things get a little bit back to normal. By way of introduction, my name is Matthew Jones. I'm on the investment team at Anthemis. We are a venture firm focused on financial services, and day to day, I spend all of my time looking at the insurance industry and backing some of the best and most exciting companies that are coming to that are tackling change in the insurance industry. To get us started, I would love to ask each of our panelists to say a few words by way of introduction. Maybe I'll start with you, Kate, if that's okay. I'd love you to tell us a little bit about who you are, what you do, and then we'll get into a few questions. You're on mute, Kate. There we go. It
wouldn't be 2021 without that, would it?
Exactly.
Also, can you see my screen? No. Okay. So hi, everybody. I'm Kate Terry. I'm co-founder and COO at Surround Insurance. I am a product manager and product builder by trainer. So at Surround, by training rather, and at Surround, we're building insurance products around Gen Z and millennial lifestyles.
Thank you, Kate. Paul.
Good afternoon, good morning, good evening, everyone. It's nice to be here. I am Paul LaPiana, work for MassMutual, and I'm responsible for our retail product domestically here in the States. That's life insurance, annuities, disability, and our worksite products.
Thank you, Paul. And Travis.
I'm Travis Hedge, one of the co-founders of Vouch Insurance. We build insurance products for the technology industry. So very excited to be here today. And I've covered the gamut from our kind of small family insurance agency here in Columbus, Ohio, to the nationwide venture team to starting Vouch. So kind of excited to talk about both sides of the coin.
See, now I told you three brilliant experts to join us for the next hour. So let's start off with a nice, broad, kind of, I guess, slightly easy question. And Kate, I'm going to come to you again to start off with, if that's okay. Maybe you could give us a little bit of commentary, right? At a high level, from where you're sitting, what is your take on how insurance has evolved over the last few years?
Yeah, so I think when insurtech kind of first became a word, maybe in the early 2000s into the early 2010s, I think there were two themes that insurtech was picking up from insurance, but doing better. And I think those were automation. This is a massively complex industry, right? And a lot of manual work is still being done. And so that was one theme. And I think the other was digital distribution. I believe the first insurance policy was sold completely online, direct to consumer, back in 1995 at Progressive, but it didn't gain steam until the startup world and the venture community kind of started paying attention. So I think really it's those two themes: digital marketing, digital UI, direct to consumer, and automation. And then I think we're at this moment now that's pretty exciting, where it's the continued development of those. But we also are asking ourselves the question, what is it that we can do with technology that we couldn't do before? And how do we respond to changing lifestyles in the wake of both the pandemic and just a general shedding of assets, moving into cities, different lifestyles, more eco-conscious lifestyles? So what can we build now in that moment that will lead us forward?
Thank you very much. Paul, what's your take? Have you been dragging your colleagues kicking and screaming?
You know what? I don't think we've been kicking and screaming. I think we've been evolving. But I think from, the traditional insurance company, and I wouldn't put Mass in that bucket, but let's just say we are for this kind of conversation right now. I think competition has been changing. So there's been a lot of new entrants into the marketplace, as Kate was mentioning, the startups. That's both insurtech and FinTech, and that could be the MGA or the full stack kind of model. I think other competitors that have been emerging is the private equity and asset managers getting into our space, buying blocks of business right now, specifically around annuities. And it's really providing sources of like permanent capital for these private equity firms. I think you've seen some of our traditional competitors exiting some companies that you wouldn't think of, like a MetLife spinning off a Bright House, Voya exiting the retail life and annuity business. As Kate mentioned, we've seen a lot of acceleration around technology and process enhancements, really driven at improving operational efficiency and helping improve the client experience, and actually even getting into new market segments. And some of this is around underwriting and e-app, e-delivery, robotics, et cetera. And then sitting where I am right now in product, we are seeing a lot of product evolution. So we've probably seen more product changes in the last probably year than in more like a decade combined. And this is a lot of de-risking, so less guarantees and shifting more risk to the consumer. Also hybrid products and kind of simpler products that have these new tech surrounds that make the acquisition from the consumer easier and simpler. That hasn't been the case with life insurance and disability and some of the traditional products over time.
And Paul, maybe just sticking with you for a second. So from thinking about incumbents kind of developing their strategy, how are you expecting them to react and adapt in this new environment?
So I think the journey has been on for a while for the right companies and the leading companies. I do think it's been accelerated because of the pandemic. And I think there's been a push over the last year and change that, hasn't been there in the past. But a couple areas that I think has been the big focus is companies are being more thoughtful and focused around what their core businesses are. So you see the incumbents exiting some businesses that they're not excited about and doubling down on businesses to accelerate their strategy where they can actually win, get scale, and have, good margins. I think also it is definitely, at least with MassMutual, forcing us to be more disciplined on our strategic investments. And that's a combination of innovation and investing in new tech stacks, but it's also modernization of the legacy systems. And there's this balance between managing day-to-day operations and then also investing for the future, which is a constant tension. And then I think lastly, there's a heavy focus on talent and culture transformation. I think part of this journey is definitely the build out of technology, but part of it's also having the right people and the right mindset, which I think is actually a heavier lift sometimes than the actual technology itself. So there's upskilling, reskilling, and then just looking for new types of skill sets to come into the organization so that we, as the incumbents, can compete in the future.
Thanks, Paul. And Travis, no one would dream of calling Vouch an incumbent, but of course you do partner with them. So what are you observing from where you're sitting?
Yeah, look, we've both partnered with incumbents, and I've seen kind of how that works from our side of the table today. But also, when I was at Nationwide, we got the venture group off the ground, and when I was at SVB Capital, about 30% of our capital base came from insurance companies. So we spent a lot of time with their innovation teams, et cetera, talking about what we were seeing. And I've seen kind of the spectrum of how that can go really well and how it can go poorly. And I think, the most important thing, well, first of all, every insurance company I've worked with starts with an innovation team, bringing in Bain, McKinsey, et cetera, kind of putting the report. I think I literally have an interview for one of those tomorrow. But just because you kind of got the playbook doesn't mean that it's executed the same way across every incumbent we've worked with. I think, the two words that I hear most frequently are it's about speed, but it takes real courage to truly empower that speed within the organization and create that alignment with the business units. But I think it's also about having, not to be maybe cheesy about it, but a growth mindset and thinking outside of the walls of the organization. I think there was this phrase that we used at Nationwide as like getting outside the jar or something like that. But I see that same dynamic actually with startups as well. When I was working with, some insurtech companies all over the country, the companies that had this instinct to say, oh, I'm going to really focus on, raising from my local investors in this local market. I'm from Columbus, Ohio, where there's a lot of insurtech companies. And I think the very best companies that I worked with were really eager to embrace the global capital markets and talent markets and get a little bit uncomfortable and really put themselves out there to really expose themselves to kind of world-class ideas. And I saw the same thing, when I was working with incumbents. I think the more insular kind of the thinking and ideation is, the less inspired it is. And I think the slower these companies move. And then let's go back to speed, right? So I think we've both worked with incumbents where they ask us to really work across the entire organization. And, you might get 8 of those 10 things to align at a given point in time. One leader leaves and it leads for a lot of problems. And so the things that I've seen be most successful personally are creating a dedicated, empowered unit that is truly empowered to make those decisions and move quickly. Because you got to get those gearing ratios aligned. A startup doesn't have, 2 to 4 years to build something out. We've got 18 months of runway, and you got to start generating proof points in the first 6 to 12 months, or you're not going to make it. Time is really our scarcest resource in this world. Last thing I'll say is, I think I got to give Greg Becker at SVB a ton of credit for this. I think he spoke earlier today. When we were kind of getting Vouch off the ground, he and I talked about, this kind of vision for insurance with SVB for a long time. And the first time I went to go pitch it to the leadership team there in 2016, they said, we really don't have we're not going to be able to build this internally. We've got a long laundry list here. I think if this is going to be successful, we got to get it outside of our walls. And, I got to give him a ton of credit for having that vision, because it got a lot of pushback, but he pushed through, and it's been key to our success.
Thank you very much, Travis. So if you're watching us right now, I just wanted to highlight that you can submit questions for the folks that are with me on the panel. They will be delighted to answer them. So do feel free to submit those questions. We'll get to them as soon as we possibly can. Kate, I'd like to talk a little bit more about Surround. So you have focused on developing kind of a new insurance product. Why is that? Tell us a little bit more about that.
Yeah. So, having been on the carrier side for a long time before this, I'll say a couple of things that I don't think anyone who's been there will disagree with. One is that, like Paul mentioned, you've got these giant legacy tech systems where if you try to change one little thing that seems simple, it touches 20 downstream systems, and it makes it nearly impossible to innovate for consumers. So that's sort of just the situation. The other piece of the situation is that insurance is divided into bits and pieces that have nothing really to do with people's lives. They have to do with the things people own in court cases 100 years ago. I mean, no consumer wakes up in the morning and says, I want to buy some inland marine today, right? I mean, it's just not a thing. And one of the things I saw sitting in that environment was that there were many consumers that we just couldn't serve. I'd read in claims reports, our driver had hit a cyclist who didn't have auto insurance of their own, and we didn't have very high limits on the policy. And I started wondering what happens to that cyclist, right? Or people calling us questions like, what happens if I get hit as a passenger in an Uber? Well, let's hope the driver is legit and has Uber's insurance, right? These are questions that have to do with people's lifestyles. They don't have to do with the things that people own. And we all know that younger consumers in particular are both living fairly precarious financial lives because of the student debt crisis and now the pandemic and all the job-related losses and everything else. But also, they're exposed to risk because they can't even buy the insurance that these protections come with. So when I joined my co-founder, Jay Grayson, one of the things that we did, because we both saw this problem, is go out and just talk to young consumers. And, nobody's going to tell you, what I really want to do is buy a new insurance product. Like if you're building a product for that reason, bad idea, right? But they do say things like, I'm really worried. I bought a term life insurance product because my parents have co-signed on my private student loans. Like, what happens if I die? Like, I'm going to stick my parents with $150,000 worth of debt, which is bizarre, right? Like, what a bizarre sort of situation, not what term life is designed for. And the same thing over and over again. What happens if I'm freelancing? I know I need insurance, but what is it? What happens if I borrow my roommate's car? I don't know if he pays his insurance. He doesn't pay his half of the heating bill half the time, right? These sorts of issues. And so that need was really what we started building for. And so I think there's sort of one thing going on within the industry itself, both startups and incumbents, and another thing that sort of other startups have died on the shoals of that we've kind of walked a middle path on. So within the industry itself, if you look, most of the startups in the personal insurance space started monoline. It is the easiest way to start. You can pick one line of business. You can raise money explaining that this is a big market, big TAM, all of that. And then they try to add additional lines afterwards, which is a heck of a lot of retooling if you didn't build a system to do that in the first place. And no consumer out there said, what I really want is monoline product, right? And then the incumbents are doing the same thing, trying to pull together different lines of business in different silos that don't speak to offer a bundle. But even those bundles typically are property and casualty or accident, health and life and disability. They're in these old industry silos, not how customers think. So that was the impetus for us to develop a platform. What we've really built is a platform that takes bits and bytes of insurance, some things you would have seen before, some things new, and combines them into a single product delivered through a beautiful front end that looks like every other e-commerce platform. And that helps you avoid the shoals of, oh, we're going to write one policy to cover every risk in somebody's life too, which just is unworkable from a regulatory perspective. So it really is that burning consumer need to feel safe and feel protected and have a safety net in life. That's what we're building for.
Excellent. Thank you. And by the way, if you are watching and you were that person that woke up this morning wanting to buy inland marine, we definitely want to hear from you. So do please drop us a line, because I would love to meet you. And yeah, I would imagine. Anyway, Travis, when I think about Vouch, I'm thinking you guys have innovated quite a bit around distribution, customer experience. Is that right? Tell us a little bit more about that.
Yeah. So, I do think there is a subset that I've met that does want to buy inland marine, but only because they've seen it before, right? So actually one of the first things we learned in starting Vouch was we surveyed, dozens of early stage founders. And I think one of the most interesting things we found was that at that company formation moment, when, look, starting a company is not like driving a car. You don't have to have insurance to get going. But 2/3 of repeat or experienced founders got business insurance out of the gate because they knew they would need it and they've seen what can go wrong. 0% of first-time founders get business insurance at company formation. So I say that because, like Kate, for us, it really starts with what does the client need? And for them, it's maybe they're at that company formation moment. And so we can go integrate with Silicon Valley Bank and be part of their account setup, or integrate with Clerky so that when they start the company, they can buy business insurance. But we also have to do a lot of education there. Our favorite partnerships and our favorite kind of engagement points are where it's required. And so that's where we've recently launched our partnership with WeWork, where they require coverage for all of their tenants, and we're there to verify COIs and fulfill needs where there's gaps. But the same thing when a company raises a round and an investor requires D&O to join the board. Our whole strategy from a distribution perspective is to identify those moments of need, really embed ourselves either within the digital product or within the more manual workflow in the case of that investor's D&O scenario I just described, and then eliminate as much friction as possible. And that's whether that be pulling in unique data sources to automate underwriting, or frankly, a big part of it for us was designing the policies from scratch so that we didn't have to ask, what year was your roof replaced, or how many square feet do you have in your co-working space when you're 3 co-founders with laptops? None of that matters. And so for us, it was the combination of identifying the client need that just so happened to align with the strategy that really enabled us to counter position against the rest of the market. 99.9% of business insurance is distributed through brokers and agents today. And there's nothing wrong with that. My dad's an agent. I have nothing against brokers and agents, but it has unlocked an opportunity for us to frankly get the first bite at the apple. The vast majority of our clients don't shop around. They actually work with Vouch because we're recommended by Silicon Valley Bank, Y Combinator, their investors, et cetera. And then lastly, it has to align with the product strategy. I don't think our distribution approach works if we were taking a broker-driven strategy, because we wouldn't be able to automatically quote, bind, D&O, cyber, E&O, all the different lines of coverage that we offer in the way that we do it, within 24 hours, right? If we were shopping around every single deal. And so that's, I think for us, the distribution strategy, that product market fit conversation, it all has to align. And we've been very fortunate to work with some of the best partners to make it happen.
Thanks, Travis. And there are a number of different kind of themes that we're going to come back to, I think, slightly later on in the conversation. So thank you very much. Paul, I think so much of innovation in insurance has, whether it's kind of intentional or not, has been related to the topic of efficiency. So whether that's around distribution, underwriting, or even something else in the value chain entirely. From where you're sitting in your role, is efficiency top of mind for you, or have consultants gone too far and they're obsessing about it?
You know what? I think efficiency is always top of mind, especially in this low interest rate environment for the insurance companies. So it's really, really important for us to be efficient so that we can get acceptable margins on our product, and then obviously improve productivity for both employers or employees and distribution partners, et cetera. That said, I think there's a lot of other innovation that's actually happening, and a lot of that is around the customer experience and customer engagement. Some of that is the platform modernization, as I mentioned, or even new platforms in general. But I think where we're seeing it is investing money and time and moments that matter, so that we can actually make our experience much more engaging and personalized for our consumers and improve the satisfaction they have when they work with MassMutual. I think there's a lot going on around product development. So as I mentioned, a lot more simplified products that are easier for clients to understand, and then packaging them with the technology platforms and the straight through processing with underwriting, so that you can actually get things done quicker with a better purchase experience. And then there's a ton of work going on with data and analytics. Companies, I'd say the life insurance segment of the financial services industries have been kind of later to the game with the data and the analytics side of things, but super important as we want to drive more profitability, improve our operations and in customer experience. And I think that'll even get more important as we look to compete into the future. So those are some of the things that we're seeing in addition to just operational efficiency.
Excellent. Thanks, Paul. Kate, anything to add from your side?
Yeah, I mean, I'd say that the efficiency that we obsess about is our customers' efficiency. Paul touched on the consumer journey. That for us is what is absolutely crucial. How do we talk to our customers about what their lifestyle is instead of the names of various insurance products they might buy? How do we serve as many of their needs as possible for safety and protection without asking them questions like, is your apartment building frame or joisted masonry? And that piece is what we are completely obsessed with, serving our customers' needs as efficiently as possible, because we're not wasting their time, and we're also building trust and showing that we know how to deal with them. So I think that's the most important efficiency for us. And then I'll just say, having made the jump from insurance to insurtech, the efficiency that comes with having brand new platforms is absolutely unbelievable. I mean, it is such a luxury to have a full-on brand new policy administration system sitting under our intelligence layer that can run any kind of insurance through it, right? That was not a thing at any of the places I've been prior to this. So one of the things we have thought a lot about is the efficiency of creating products. How in the insurance industry, given the regulation and all the things that we need to do, can you develop products at scale and at speed that are responsible both for the consumer and for whoever's got your paper, whether it's you or somebody else? And how do you think about what you build because it's unique and you have an advantage in terms of data or an advantage in seeing a market need versus when you pull in somebody else's product because they've got those advantages and you can combine it with yours on our platform and make it look like one beautiful bundle to the consumer. So I think we've thought about efficiency, but not in the traditional how much manual work do we need to do kind of insurance efficiency issue.
Excellent. Thank you. Travis, maybe coming back to something that we started to explore earlier on. In your view, what should startups focus on when they're working with incumbent carriers to ensure successful relationships between the two?
Yeah, look, I think like any successful business relationship, it starts with alignment of interests and really understanding what matters to each party. Like if you're an early stage company just getting off the ground, what matters is finding product market fit and moving quickly. That might not be, what's in the interest of your insurance carrier partner. And so I think it's important to meet a lot of different people in that process, explore what matters to them. But it really does depend on the line of business. For us, we took a pretty heavy look at the full spectrum from, what if we really were just the distribution layer all the way to, starting off as a full stack carrier. And based on my prior experience, I had a heavy bias for going full stack out of the gate. But it became obvious very quickly that, look, the regulatory and capital requirements when you're writing 10 lines of business where all the counterparties require A-rated paper, probably doesn't make as much sense. And so, we were fortunate to work with Munich Re Digital Partners to really get off the ground. And I thought we had pretty good alignment of interest there. They wanted to work with early stage companies. For them, I think it was mostly a learning exercise. But they had set up that unit to empower them to move pretty quickly. And, I think all things considered, that worked pretty well. However, we've continued to evolve and have been transparent that our goal is always really to build an insurance company. So we launched our carrier, a couple months ago, but we continue to work with a number of carriers across the board. Whether it be the other carriers on our reinsurance panel alongside the Vouch insurance company, or the conversations we have, exploring new products like Key Person, et cetera, that we need to go build out in the future. And so I think, again, it's just really important to understand what matters to them. And look, if our interests aren't aligned here, I think, for instance, today, our current carriers care about working with us because we think and they think that we have a defensible distribution advantage and that we've got the talent to continue launching new products and iterating at a high velocity. They care about earning profits, and they've bought into that story, right? And so have we. Early on, that we couldn't promise profits. It was about the learning alignment. And so, again, I think it's really building those relationships over the long haul, which last thing I'll say on this is we did hold off on bringing on strategic insurance capital into the business in the early days, partly because we were both in learning phase. And, it's kind of like you're in the dating phase of a relationship. You don't want to get married on the first date, but you do want to create that tie-in. Now you go fast forward to today. We know a lot more about ourselves. Our counterparties know a lot more about us. And we're creating that long-term lock-in, and we were excited to bring a couple key partners, into our last round.
Thank you, Travis. Paul, same question to you. What would be your advice, perhaps, to startups that want to work with you guys? What would be your recommendation?
Yeah, this is an interesting one because we actually get the opportunity to, visit with a lot of startups. We're actually working on some stuff with Kate right now, and so I think one, just playing off what Travis said with alignment of interest is the startup should have a really good understanding of the strategic direction of the company and the initiatives that the company is actually, looking at with their strategy. What businesses are they in? What are they trying to get in? What problems are they trying to solve? Also, clarity on the value proposition, like what is it that the organization is bringing to the table so that you can get actually, people's attention. And this would actually lead to the next one, which I think is really important, is internal sponsorship. So having somebody at the company that understands where the fit is and actually can champion the cause and be accountable to move the agenda through the organization, because the companies are super busy, a lot of competing resources, and you can get bogged down real quickly if nobody's actually owning it. I think a couple other things that are kind of tied together is being light touch, making it easy for the company to engage without a bunch of heavy lifting so that people will continue to move it along, and starting in kind of a pilot mode so that you can actually validate that it's bringing the value and start to get adoption. And the last one, which I know is not always fun, but I think is important, is just being patient and persistent, because it is it's taking the long-term approach and letting it play out. And sometimes people don't have too much time, but I think that's the thing that's important, is it's going to take a little while, and you got to just be persistent through the process.
I think that's great advice. And I think people, this point about the sponsor is really important for me. And actually, even as an investor, we will diligence this point. We will dig into who is your sponsor, where do they sit within the organization. There are some people that you absolutely should be working with in an organization. Of course, there are also people you should absolutely be avoiding if you want to get stuff done. But I think the sponsor is absolutely key. And they can really make or break some of these kind of partnerships. Looking ahead a little bit, Kate, perhaps you could tell us a little bit about how do you see startups' relationships with incumbents kind of evolving over this kind of next period? And I don't know kind of what time frame you want to put on it, but I'm keen to hear what your take is.
Yeah, absolutely. So I've got an idea about how they're evolving, and then I've got what I think is the biggest question. So in terms of how they're evolving over, say, the next 5, 8, 10 years, I think it's much of what Paul was saying already. It really is about partnership. There's been a lot of rhetoric from some startups about how the insurance industry is broken and we're here to fix it. The reality is that something that's complex doesn't necessarily work that well, but this industry exists for a reason, and it's because largely it works. There are places where it really doesn't. They need to be fixed, but largely it works. And so I think what we're seeing is partnerships where the startups are plugging into places where things don't work that well and working with the incumbents to fix them. And I think you're getting a separation among the national carriers that are those that are sort of known to be good to work with across product distribution and their investment arms, and those that are much more difficult, right? When you're a startup, your cost of capital is super high. What are you going to do? So I do think we see some spread there among great partnerships and maybe some that are left out. But I think the biggest question for the industry is this. A huge chunk of the insurance industry is dominated by regionals, by mutuals, by regionals, and a lot of them are sitting on an awful lot of surplus relative to the amount of premium they write, but without really the resources staffing wise to take part in some of what's going on in terms of modernization, automation, modeling, AI, all of those sorts of things. And so I think that's a really fertile ground for one of two things to happen. I mean, either they're going to get left behind and kind of gobbled up by larger carriers, or there's an opportunity for some of them to step into this startup world as partners, as investors, in whatever way. And they've got, the surplus to back it up. So I just think that's the biggest question mark in terms of what's going to happen between startups and incumbents over the next few years.
Extremely astute observation. And if anyone is representing an insurance company and is sitting on lots of surplus and they want to put it into a venture fund, I could definitely help you out, although I'll probably get told off for marketing there, so I'll move on. Travis, anything to add before I go to a couple of questions from our dear audience?
No, it was a great pitch. Kate, I think to your point, I think do I think that the narrative that insurance is broken is overplayed? Yes. Although I do think that part of what you and I are both working on, there are some inefficiencies or some things that are broken. And I'll point to a couple of things there. I think the Risk Institute at Ohio State did a survey of small businesses, and they reported 24% of small businesses have reported, a cyber breach, a cyber incident in the last few years. But when we look at some third-party claims data, only 6% of those kind of accounts have filed a claim. And so there's a massive sort of undercoverage problem. I think, I talked about first-time founders earlier, et cetera. I think there's, what we need to focus on is what keeps people up at night. What are the biggest risks in their business and how do we solve them? I think there's that rule of thumb in our world of business insurance that 30% of business risk is insurable. Well, if that's been true for the last several decades, and we now have much more data at our disposal and the ability to truly integrate with the tools these companies are using day to day, why can't we expand the TAM of that market to 35, 40, 50% in the same way that Uber, Lyft, and others fundamentally expanded the taxi rideshare market, right? And so I do think there's a big opportunity to do that. And I think, as it relates to how incumbents and startups work together there, I don't think it's one size fits all. And I think like anything, you're going to continue to see some incredibly successful relationships, and you're going to see a lot of unsuccessful ones. We got to try a lot of things to see what works. But I do think you're going to continue to see two things. One, the infrastructure layer is going to continue to be democratized in the same way that it has other categories, right? We talk about capital. Sounds like Kate and I have both built our own policy admin systems. I would have loved to just truly plug and play into something there. But, those tools just aren't quite mature enough yet for the more complex lines of business. And I think we're going to continue to see more and more of that. Companies like Vouch, Surround, and others, hopefully opening up our infrastructure over time to help others build. But I also think that we've been in this disaggregation moment, right? So if you go back to the problems I talked about around whether it be cyber or small businesses, I think we're a good example of this. We're hyper-focused on venture-backed technology and life science companies. It's a pretty narrow solution. But I also think we're starting to see that re-aggregation moment that these industries go through starting to crown a little bit. I think a question for everyone over the next few years as we move into that is whether you're going to be a buyer or a seller in that environment. And I think historically, we've thought about the incumbents being the buyer. But I think, especially right now, you've got insurtech businesses with some pretty unique opportunities to arbitrage the multiples on their equity. And I point to what Newfront and ABD have recently done as a great example of that. So, I think we're going to continue to kind of move in that direction. I think both incumbents and startups are going to be buyers and sellers. And it all comes back to, I think, how you can really, position yourself both from a capital perspective, and you just got to move quickly to take advantage of it.
Excellent. Thank you. Okay, we're going to go to a couple of questions from the audience that have joined us. And I'm going to go to Kylie's question first, if that's okay. And so I'll leave the panel to put their hand up to take this one, if that's okay. Managing risk is what has made so many insurance companies successful, and innovation requires risk-taking. How do you think about managing that dynamic internally? This is a really good question, and I can see everyone is dying to answer. Paul, you go for it.
So this is Kylie and I work together. So I don't know if I should be able to answer this, but when I read the question, I was thinking it was kind of coming at the incumbent mindset, right? And so what I think about this is, yes, it's about managing risk for sure. And I think the incumbents, as they innovate, just have to be thoughtful about balancing running the day-to-day business through traditional channels versus building for the future and getting to new markets so that you can, quote unquote, keep the lights on today so that you can build and grow into the future. I think that's really important. Now, managing it internally is also important for your employees so that they understand what we're doing and why. So I think the why is this important, this transformation effort, and I think you all are articulating, and we know consumer preferences and consumer behaviors and the world has changed. So there is a very compelling why, but then it's aligning the senior leadership in the company to be deploying resources and having consistent communication so that you're not confusing your stakeholders internally of what the journey's all about. And I think that is part of the risk, is not having people be clear on what we're doing and how you sequence and cascade certain, resources, people, and capital investments. So that's, Kylie, my best answer to your question.
I love that your colleagues are giving you really hard questions.
That's
great.
it.
That's great. Travis, Kate, anything from either of you? Otherwise, I'll move on to.
Kate, I was quick with you on mute. You go ahead.
Oh, all right. Next time it's your turn then. I was just going to point out that as a startup, you need to choose in the insurtech space which risk you're going to take, right? So for us, we started Surround a little bit later than the earliest wave of insurtechs, a few years later. And so we were stepping into an environment where many of the reinsurers' balance sheets had been burned by some of the earliest insurtechs, right? And that is a strategy: grow as fast as you possibly can, raise enough venture capital so that you can become a going concern. But unfortunately, that is almost always going to scorch the balance sheet underneath, right? And so we chose a different risk, right? The risk we took was executional. Can you build something that's got a fairly complex set of product levers underneath it that then gives you the option to grow more sustainably from a loss perspective, and hopefully keep those partnerships with reinsurers and others in the industry, right? So you do have to pick your poison somewhere, unfortunately, as an insurtech. There's no risk-free way to do this. And if there is a risk-free way, it might be reward-free as well, right? But I think there's some of that. And then the other point I wanted to make was that, yes, insurance people tend to be risk averse, and that's great in a lot of ways. Maybe always have enough surplus to pay claims, right? But stepping into the insurtech world, you need both a combination of risk-taking, the risk-taking that comes out of sort of the tech industry, and also the risk moderating that comes from the insurance industry. And I think some of the very best companies that we're seeing now have that mix of insurance and tech leadership. And I think that's really exciting for where this space is going.
Yeah.
I don't know, Travis, did that overlap what you were saying, thinking at all?
A little bit. No, I think you both hit on a lot of things I strongly agree with there. Particularly the last part there, Kate. I think the reason I lit up like a Christmas tree when this topic came up is I literally give a talk on de-risking startups for every YC batch. And it's something that, it's a little self-serving as like the insurance guy, but I really think it's important that founders, I don't care if you're in insurance or you're building a B2B SaaS startup, to think of it through the lens of de-risking your business, because every investor that's going to look at your company, I've seen dozens and dozens of different firms' investment memos, and there's one common theme. You break down what are the risks in the business, what are the mitigants to those risks, and what are the strengths. And, when I went back to try to pitch Vouch in 2016, if I'm being honest with myself, someone looking at that, every single thing that matters would have been in the risk category. You've got a young, unproven founder. You've got this big capital intensive market. People hadn't proved it out yet, blah, 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 right? Didn't have distribution figured out. And so frankly, I spent the next few years like chipping away at each of those risks. And then by the time we ended up really starting the business in 2018, a lot of those things had moved over to the strength side of the ledger. I think, but to be clear, still working on all of those, really all those items. Now, I think the other piece of this is we had teamed up with Hillary Smith. She was the former GC of Square, and a couple other people in the early days to say, hey, like enterprise risk management really matters for startups. What can you do to actually boil this down in a way that works, right? I think over the last few years, you've seen public companies go from less than 20%, I think, had a risk committee to over 90% today. And so there's a lot you can learn from big companies, but it's not going to work at most startups. So the thing that we preach and run these workshops on is say, ask your leadership team, what keeps you up at night? Then you take those answers, and they can be actual like insurance risk related, or they could be, I don't know, I think we have a hiring problem. And then you ask yourself, okay, what's the likelihood that's going to happen? What's your frequency? How bad can it be? What's your severity? And then what are we actually going to do about it? And we've got a little like risk register that our GC Kelly manages at Vouch. We check in on once a quarter. And I think every startup should have some exercise that they do with their leadership team. It can take an hour, but doing that on a regular basis can go a really long way.
Thanks, Travis. I'm going to go to a question from, I think it's pronounced Anil. I apologize if that's wrong. Hi panel, for new innovation in the insurance space, are there any challenges in terms of regulation? Are there some things that only big carriers are big carriers better placed to push the barriers there? And if anyone can provide any kind of examples or case studies on that topic, anyone want to talk about regulation and thinking through how to tackle that?
Yeah, I'll take this one first, and then I'm sure you both have something to add.
Thanks, Kate.
Yeah, so I think there are two pieces to regulation that matter a lot. One piece, which I'll leave to maybe Travis and Paul to talk about, is statutory capital, right? Like what kind of capital you need to support a carrier license. We didn't really think too hard about that path. We at Surround went with a capital light structure called the Managing General Agency. So I'm going to put that aside and let someone else speak to that if they want to. But I want to talk about the product regulatory piece of this, right? So there's so many things in the insurance industry that people say, oh, I can't do that because of regulation. And really, you can't do that because in 1960, somebody built some software that assumed something about the regulation. Now everybody believes that it's the regulation, not just the history of something that's been propagated over time, right? So a couple of things. If you actually read the insurance regulations, there are a handful of things that they absolutely keep you from doing, using credit in underwriting and rating in some states, for example, for personal lines, not using fresh data for certain kinds of information for customers. Those sorts of things are hard and fast regulatory rules. Most of the rest of the rules really are about how to talk to your customers to make sure that you're telling them if you're going to non-renew their policy, et cetera. They don't prevent you from innovating. They don't prevent you from using different kinds of technology. Like, read the regs, people. They really are relatively approachable. The other thing I will say is that Jay and I, before we decided to get started building it Surround, one of the things that we thought was really important was to get out and to meet with departments of insurance, because most people probably know, but if you're not in the insurance industry, insurance is regulated in the states, state by state. If you have a product that fits into a category that needs to be approved by regulators, which is most of personal lines and much of commercial lines, then the regulators need to actually approve your product before you stamp it approved essentially before you sell it. So one of the things we did is we went on this giant, like our founding story includes this giant road trip through the Midwest, meeting with the commissioners of insurance and their teams in a bunch of different state capitals. And we heard a couple of things we heard were, my goodness, startups usually come in after they've launched something and we've already fined them and then talk to us and we're relieved that you're here. And then second, we heard, if there's anything we can do to help you, give us a call and we'll help you out. And then third, we heard, you realize we're regulators because we want to protect consumers. And so if you're talking about doing something that helps consumers, but with more market availability, different kinds of products that protect people from risk, yes, we want all in on that. So I think the lesson is not to assume about regulatory issues and to sort of reach out and talk to the regulators, because you can do an awful lot more than you might assume.
Gosh, Kate, if I knew that you and I were so aligned on things, I swear this was not planned, but we should catch up after this. So I think we took a very similar approach. Regulators at the end of the day are people, and this is a relationship industry. And so I think one of the best pieces of advice I got was if you are going to go full stack and domicile a carrier, it better be where you're actually based, because you got to go build a real personal relationship with that the head of the DOI there. So that was one. We chose the domicile in Illinois because the vast majority of our company is based there. But I think the other thing is it comes back to what we talked about earlier. It's time and speed. And I think, one of the first decisions we made was to hire Kelly as our GC, as I think our 4th or 5th employee. She was, one of the key players in cleaning up the regulatory mess at Zenefits. And so she had built a lot of great relationships with regulators across the country that enabled us to A, move a little bit faster, but B, ensure we were actually laying the right foundation so that we weren't that startup coming in begging for forgiveness down the line. Because, and this comes back to the speed thing, our products needed to be admitted. And so one of the first things we did was lay out, okay, where are there big venture communities? Where are the insurance regs, file and use, for instance, from a commercial perspective? And that's how we ended up launching in Utah first. But I will say, I think the fact that insurance is regulated on a state-by-state basis in the US, I think is incredibly anti-competitive. And here's what I mean by that. In theory, we talk about all these small markets competing against each other, and that's how you breed great ideas. I used to be in politics. I used to buy into that argument. I think it's total crap, because it just adds a bunch of complexity and barriers to entry for companies that are trying to do the right thing by consumers. I think the best regulators truly do have the consumer's interest in mind, and that might mean asking you hard questions and pushing you to come to the right answer. I have no issue with that. But if someone could tell me why certain regulators think that our clients shouldn't have IP protection or cap table coverage just because they've never heard of that before, I think the challenges that I see are when you try to introduce truly novel products. That is what, frankly, the surplus lines markets were really created for on the commercial line side of things. And I think when we've tried to bring truly novel products to certain regulators, we get so much pushback that it's ultimately against the consumer's best interest, because look, you have 18 months of runway as a startup to figure it out. At some point, you got to decide to pull that feature and just go forward with a more vanilla filing. And, I don't think that's in the best interest of the end consumer.
Yeah, and Matt, the only thing I would add, I think both Kate and Travis hit all the key points, but this is the strategic decision as the startup. Do you want to go the MGA type model, or do you want to be full stack? And you think about the advantages is if you can pull off the full stack and get the capital and the scale, have the runway, you really can differentiate your value proposition, because you aren't encumbered by all the legacy systems. You got the talent, the culture, the speed to market, and the modern tech platform, which is amazing. I think the watch items, though, is how do these companies, if you want to go full stack, navigate through what Travis was just talking about, the complexities of the insurance regulatory framework, which is sometimes exhaustive, and it takes a while to get through, especially if you want to go through multiple states with products and broaden out your footprint, which actually makes it more interesting for incumbents to be partnering with some of the companies too, when you can get more broad distribution. But at the end of the day, how much does that slow down your ability to build your business? And do you have enough runway to actually get to the finish line with all of the approvals, the capital requirements, and the financial reporting that goes along with it? So I think that is a big piece of the strategic decision up front for the leaders that are, on this phone and attending the conference, over the next couple of days.
Paul, sticking with you, maybe just to move on through a couple of other questions here. So embedded insurance has gained a lot of attention over the last few years. How big a part of your distribution strategy is embedded as a proposition?
So right now in our traditional channels, you would say in the truest sense, it's not a lot of embedded options with our advisors and third-party distributors. And so do I think this will emerge over time? I really do think it will. I think it does depend on the types of products, though, and the types of coverages. So for more simplistic type products, I think it works really, really well. As you all know, those products have a little bit more thin margins a lot of times, and you need to drive volume. And if you can actually embed it in other types of services or products, have lower distribution and acquisition costs, you're going to be able to get to certain segments of the population that we have not done well as an insurance industry, like serving the middle market. And this opens up, revenue and profit pools. I think if you can also partner with other industries that might not even be in the insurance business and embed some of our products into their offers, it makes it enticing because it allows them to offer some new opportunities and solutions to their customers. It engages their customers in different ways. And they've also got some profit streams and revenue streams that they weren't playing in before. So I think there's a lot there right now for where we're predominantly distributing that. Not seeing a lot of this happening, but as simplified products emerge, and they are, I think you'll see more of it.
Excellent. Thank you. Kate, anything to add on embedded as a theme?
Yeah, I think there are three things. I think one is that I would divide embedded insurance into two groups. I think there's the piece that we've seen more of where you've got simple digital products like Paul was referring to that are closely related to the purchase. So I bought something from Home Depot yesterday and they tried to sell me, protection from Allstate for $2 or something. That kind of embedded makes sense, travel insurance. And you're not increasing the moral hazard associated with buying insurance for that product in those types of cases either generally. And so that works quite well. But that's sort of a limited subset of fairly small e-commerce transactions or other kinds of transactions that you can tag insurance to. I think the other part is you can call it embedded, or you can call it a partnership of some sort where you're already buying a fairly complex set of products, and therefore a fairly complex insurance solution can also make sense. Like imagine you've got a neobank and you've got your credit card and a bunch of financial services with them, and some kinds of insurance services may make sense alongside. It's already a complex sales process. One more complex kind of product is sort of okay. And both of those significantly reduce the cost of customer acquisition, which is so sky high in our industry, right? I mean, that's a major issue for startups and incumbents both. So I think those both matter, but it also almost creates a new problem for consumers that does worry me. And I don't know what the solution is, which is just that you can get to the point where you feel like you're in a world where insurance is included with everything, right? I checked the box, so I must be covered. But you're not covered for all the things in your life that are not related to embedded insurance processes. And so I'm not sure yet, maybe there's a great startup idea out there about how to plug the insurance around what's embedded so that people are still safe. And that I think is a major customer problem going forward.
Hey, Matthew, can I add one thing here that I've learned recently in this, which that trade-off, by the way, between simplicity, complexity, spot on. We're wrestling with that in a few embedded products we're building right now. So, whether it's with every embedded product we're building is with an incumbent of some form. The question is, are they digitally native or not? This is a learning for me in like the last literal week, probably. The digitally native incumbents we work with, the questions they ask and what they're trying to learn are fundamentally different than what I hear from the kind of non-digital native incumbents, where when we're scoping these things out, it's let's go do a bunch of user research. Let's really analyze this whole thing and then go launch the full vision. Whereas we're getting ready to launch something with a digitally native incumbent. And the question was, we're like, hey, what metric matters most to you here? What should we be optimizing for? And they go, technically it's conversion and NPS, but to be honest with you, we just want to get feedback and see whether people will buy this thing before we both go commit the resources to really building it out. And I think that just like test and learn ethos has worked. We found to work better for us as a startup.
Thank you very much. Travis, let's stay with you for a second. So as competition in the industry continues to increase, how are you thinking about kind of creating a sustainable competitive advantage over time? Is it through your underwriting? Is it cultural? What is your take on that?
Yeah, it's all of the above. And I think it really depends on the business. Like this answer should be different for every business. But I remember going to some insurance conference a few years ago. And I mean, to give you a sense of how dated this term is, it was, I think, he who controls the customer wins, not like they who controls the customer wins. But, I think there's some truth to that in insurance for sure. And that's why go-to-market distribution for us, I think that, I don't know if you've seen that meme floating around of, first-time founders focus on product, second-time founders focus on distribution. I think that's very, very true. And so for us, we've thought about how do we make distribution a durable competitive advantage over time? really from day one. But the other thing is, you look at lending as an example. I think there were a lot of companies in the lending world that came out and said, hey, we're going to build differentiated underwriting. And what they ultimately found is I think it's primarily a distribution and cost of capital play. There's a few, though, where when that distribution strategy is unique enough, like Opportune, for instance, you actually are able to drive perhaps differentiated underwriting over time. And so for us, it's two things. It's by building those exclusive distribution pipes into the best possible partners, we're skewing our funnel towards the highest quality companies, not necessarily just from a risk and underwriting perspective, because, for instance, Silicon Valley Bank is already doing their own level of diligence, but also because you want to tilt it towards those top 10, top 20% of companies that are going to be really big someday. So that's one piece of it, how I think distribution can tie towards durable underwriting advantages. And then the second part of that is data. But the only way that I think, as a startup at least, you can build true durability is speed is your best advantage. And if you're not creating a culture by which you are increasing your velocity and moving faster than the incumbents, then I don't think you have much of a chance. And that is where I think culture really matters. And we're very proud of the culture we've built here. It's got to be authentic to who you are as a founder. You can't force that. So I think it's all the above.
Thank you very much. Paul, from your perspective, what do you think will ultimately distinguish the long-term winners in insurance, insurtech? And how does this connect with what you're focused on day to day?
Yeah, I would say that, just going back to just the basics of what all successful businesses are going to need is, one, you got to have strong, innovative, and persistent leadership. And when you tie it to the conversation we're having, I think that leadership, setting the tone and driving cultural change within the organization, going from where we are as an incumbent to where we want to be going in the future, is a big piece of it. It's bigger than the actual build out of the technology. I think having the right talent in the organization, and I think Travis had mentioned it, with an outside in agile mindset, also really, really important, because that's not traditionally how we've always been thinking in the insurance industry. I think successful insurance companies moving forward, it's always going to be important, and probably more important now as we move forward, as you see the players changing. Strong brand, ratings, and capital position will be important for success. I think having leadership positions in our chosen lines of business, obviously digitally enabled for all the reasons we've been talking about. But I think one other thing is ownership structure. And I've had the opportunity to sit in both publicly traded insurance companies and mutual companies, and MassMutual is the first mutual company I've been part of. And the one thing that I was pleasantly surprised is the ability to think longer term. It doesn't mean that you're immune to the pressures of low interest rates, market volatility, et cetera, but allowing you to think longer term and align the interests of all of your stakeholders. That's leadership, that's policyholders, and that's your distribution partners. So when I think about success in the future, that's definitely applying to us as the incumbents, but I think it also, some of that applies to running these startup organizations moving forward.
Thank you, Paul. We are coming up to the last few seconds now. And so I wanted to ask each of you, we're joined by a few hundred people here that are watching. Starting with you, Kate, who would you like to meet or hear from after this session? Who should be getting in touch with you?
Anybody who believes that we as an industry can do better for Gen Z and millennials.
Brilliant. Thank you. Paul?
I would say, looking at MassMutual, and everybody knows where we actually play. Also, not everyone knows, but we're a very innovative thinking company. So if you've got great ideas that you think you can help us build towards the future, love to have those conversations with you.
Thank you. And Travis?
If you're a startup or an investor, you definitely need insurance. So just head to vouch.us. But if you're a capacity provider and you're excited about working with startups, please reach out. It's travis.hedge@vouch.us.
Thank you. And from my side, if you are a startup looking for funding, or if you're an insurance exec looking to get involved with insurance startups, please do get in touch. Would be delighted to continue the conversation. I thought that was great. I've not had that much fun in the middle of the afternoon for a very long time. So thank you very much to everyone for joining us, talking about kicking and screaming. changing the insurance industry. This was a great session. Thank you very much to the panelists, Kate, Paul, and Travis, and to everyone that joined us to ask questions and to get involved.
Thanks, Matt. Thanks, everyone.
Thank you.
Thank you.